Hi, welcome to this podcast where we're going to be looking at accrued and prepaid expenses. Okay, the theory is that what we should be doing is following the matching concept. So expenses should be matched to the year in which revenues occurred. We'll look at a couple of simple examples, and then you'll do some examples, and then I'll look at some more difficult examples. Okay, in this case, somebody called Ponting had paid $8,000 for motor vehicle repairs in the year, and there's an additional invoice of $350. So although there's been $8,000 worth of payments made, he's got what's called an accrual, or an expense which hasn't yet been paid at year end of $350, and therefore his actual expense for the year should really have been $8,350. Looking at how we do it, and this is something that really trips up students, you should make sure you certainly get at least the easy marks. All the way through with expenses, whenever we've paid an expense, you've credited bank or cash, and you've debited the expense account. So we still do that with the $8,000 worth of expense. We now get the slightly more difficult bit, but there's two ways of looking at it. The first way, and probably as easy way as any other way of looking at it, is an accrual needs to get added on to the expense. So if it's going to get added on, it's got to go on the debit side along with the amount that's gone through the bank. The other way that some students look at it is that we know that next year we're going to owe some money. So at the start of next year, we're going to have a balance brought forward of $350 on the credit side, okay, because it's not part of the expense. So it's going to be paid next year, it won't be part of next year's expenses. So it's a liability at the start of the year, and therefore the balance carried down is a bookkeeping entry to make sure that's in the right place. So either way, the balance carried down has to go on the debit side. Okay, and then I need to write the right date there, 30th of June 2016. The amount that will appear in the income statement will be the whole $8,350. Okay, so the income statement extract $8,350, and the one that's a little bit different, the statement of financial position. In the current liabilities, we've now got something called other payables. So trade payables is just for suppliers that we owe money to. Your other payables, which are going to be $350, are other people that owe money, the business owes money to. Okay, we can also have the opposite type of scenario, and that's where we've paid too much rent. So in this case, the rent paid was $6,500, but $500 of that belonged to the previous year. And therefore what we're going to do is we're actually going to subtract $500 from $6,500 to find out what the amount of expense should have been for the year. It should only have been $6,000. Okay, looking at how we fill in the ledger accounts, well, we've still paid either through the bank or cash $6,500. So we will have credited bank or cash, and we therefore need to put a debit entry in the rent account. But this time it's a little bit different. The prepayment has got subtracted, and therefore it needs to go onto the opposite side as a balance carried forward to the main cash or bank transaction. So it goes on the credit side. And it goes on the credit side because next year it's going to be an asset to the business, and also in the accounts it's going to be an asset to the business. So the balance brought forward has to go on the debit side, reflecting the fact that the business has an asset of either being owed the money back for the rent or getting the rent, and therefore the accounts balance off in this case is $6,500, and therefore the amount appearing in the income statement will be $6,000. In the income statement, therefore, as an expense, we've got $6,000 worth of expense, and it'll be called other receivables rather than trade receivables in your current asset section of the balance sheet for $500. Right, you've got student worksheet 2 to work through quickly. There you've got a couple of examples where we've just got year-end accrual and then a prepayment. And then, so pause the video And then when you come back, we'll look at what we do with opening accruals and prepayments. Welcome back. Okay, now we've got a slightly different scenario. In this case, there's an opening accrued expense. So there's an expense from last year that hasn't been paid. And then we've got the amount going through the bank, and they still owe wages of $800. So if we start with the amount that goes into the bank, because that's a basic expense, okay, that starts at $12,600. But $500 of that belongs to the previous year. So we don't want to include that as part of this year's expense. So the expense when we allow for the opening amount will only be $12,100, but then we've got $800 of wages which are still owed to the customers. Well, that's just to employees. Well, that's going to be added on, so that's going to increase the amount of expense for the year. Okay, I'll just write add in because obviously I've got a problem there. Okay, so the total expense we expect to see in the income statement will be $12,900. So let's look at the logic of how we've got that. Well, the first one is the opening balance. The opening balance was a liability at the start of the year, so that goes on the credit side. The bank is an easy entry, so we should always get a mark for that. That goes on the debit side, it's $12,600, what was actually paid. And the balance carried down, we're going to add that on, so it goes on the same side as the bank entry because it's going to increase the amount of expense. The balance brought down is going to go on the credit side because it's a liability at the start of next year. The accounts now are going to balance off at $13,400. And that means the income statement amount, as we've rightly corrected, calculated above, is going to be $12,900. So pretty straightforward. The amount we've calculated against the income statement appears in expense. And in our current liabilities, we're going to have an other payable because at the start of next year, they owe $800 worth of wages. Okay, and then a final example here, we've got prepaid expense of rent. So starting with the basics, the amount that's gone through the bank has been $9,600. $900 at the start of the year have been prepaid, so we need to increase it because that's part of the current year's expense. So $1,000 is being prepaid at the start of the year, so we need to add that on because that's going to be part of this year's expense. So at the moment it looks like our expense is at $10,600, but then we've got some rent paid this year which will be included in that $9,600 that actually belongs to next year, so that's going to reduce the amount of expense. So the expense that we should see is $9,700. And looking at putting that into the ledger account, well, we're starting off with an asset. The business has owed some rent, it's part of this year's expense, but it's an asset at the start of the year. So that goes on the debit side because it's an asset. The amount that's gone through the bank, $9,600, is in the debit side of the rent account because we credit bank or we credit cash and we debit the expense account. And the balance carry forward, it's a prepayment, so part of that $9,600 isn't this year's expense, so it needs to go on the credit side. And it also needs to go on the credit side because next year that will be an asset for the business. So that will appear in the statement of financial position as an asset. We then look at the totals. Okay, well, both sides should balance off at $10,600. So hopefully the amount that goes to the income statement is $9,700. It's $10,600 subtract the balance carry forward. Okay, and then very quickly, this is what appears in the income statement and statement of financial position. The 900 appears as an asset, 9,700 is an expense, and you've got two questions to do, very similar to what we've just done, so good luck with that. Any questions, see me, and don't forget to email them to me.